Let's run a thought experiment. Imagine Honda hits the brakes on its massive $15 billion electric vehicle investment in Canada. A move like that would be more than just one company changing its mind. It would be a massive warning sign that Canada's entire multi-billion-dollar EV strategy could be on shaky ground. How would we get to that point? And would it be the first of many dominoes to fall? For a company like Honda, one of the world's most careful and respected automakers, to shelve a flagship project would be a huge deal. It would send a shockwave through the foundation of Canada's industrial policy, a policy that has wagered tens of billions of taxpayer dollars on an electric future. For years, we've heard grand pronouncements from Ottawa and provincial governments about making Canada a global leader in the EV supply chain. We've seen the photo ops, the handshakes, and the announcements promising a new golden era for Canadian auto manufacturing. But a hypothetical move like this from Honda, a company with a deep history of manufacturing in this country, would speak louder than all the political rhetoric combined. It would raise a wave of uncomfortable questions. Have our governments, in a rush to compete with the U.S. Inflation Reduction Act, thrown good money after bad? Is the consumer market for EVs actually ready for the flood of production these mega factories are supposed to create? And, maybe most critically, is Canada's economy just too vulnerable to the whims of American trade policy, making huge, long-term investments like this simply too risky? This isn't just about one plant. This is a stress test for Canada's entire 21st century economic model. It's about whether our strategy is built on solid market realities and smart policy, or on a risky bet propped up by subsidies and wishful thinking. The suspension of a project this size would be the moment theory collides with reality. A prime minister calling the decision disappointing would be an understatement. For workers hoping for new jobs, suppliers planning for new contracts, and taxpayers promised a solid return on their government's investment, it would be a profoundly troubling development. Here, we're going to unpack every layer of this hypothetical story. We'll explore the reasoning a company like Honda might have, the shaky ground under the North American EV market, the incredible scale of the subsidies propping up this sector, and the geopolitical storm clouds gathering south of the border. This is the story of how a multi-billion-dollar dream could be put on ice, and what it would tell us about Canada's economic future. First, let's establish the hypothetical facts to understand the sheer scale of such a project and the impact of its suspension. Picture this: Honda Canada confirms it's indefinitely suspending plans for a massive $15 billion electric vehicle hub in Alliston, Ontario. That term, indefinite suspension, is deliberate and chilling corporate language. It's not a final cancellation, but it's not a simple delay with a new timeline either. It's a project put into a deep freeze with no thaw date in sight. This wouldn't be just any factory. The real project, announced in 2024, was billed as a cornerstone of Canada's green industrial revolution. The plan is monumental, an entire, comprehensive electric vehicle supply chain. It's set to include not just a new EV assembly plant, but also a dedicated battery factory and several other component plants. It's a whole ecosystem designed to build the next generation of vehicles from the ground up, right here in Ontario. The project promised the creation of at least 1,000 new, high-quality jobs directly at the facility, on top of the 4,200 workers Honda already employs in Alliston. The ripple effects would be enormous, supporting thousands more jobs in construction, logistics, and the huge network of parts suppliers. Production was slated to begin by 2028, with a capacity to roll out up to 240,000 EVs a year. This was meant to be a flagship of Ontario's renewed manufacturing power. In this scenario, Honda would be careful with its messaging, reassuring the public that current operations and jobs are safe. The existing Alliston plant, a community pillar for decades, would continue producing the popular Honda Civic and CR-V. But that reassurance wouldn't do much to soften the blow. Those 1,000 new jobs would become a phantom, a future that vanished. The billions in expected economic activity, the tech advancement, the anchoring of a next-gen supply chain, all of it would be on hold. The local impact can't be overstated. For a town like New Tecumseth, where Alliston is located, this was a generational promise. Any reversal would send a signal to the entire global investment community about Canada's competitiveness. The project was so significant that both the federal and provincial governments pledged a colossal amount of public money to secure it, reportedly up to $5 billion in combined funding. In our hypothetical suspension, Honda would confirm that none of this money had been transferred yet. While this protects taxpayers from an immediate loss, it does nothing to address the larger strategic failure. The government bet big, and in this scenario, that bet wouldn't have paid off. The suspension would represent a massive hole in Canada's industrial strategy. When a company like Honda makes a drastic move, the world listens. A carefully crafted statement might point to evolving business conditions or shifting customer demand. But to really get what's happening, we need to translate that corporate speak into the harsh language of market reality. This isn't just about one company. It's about a fundamental split between the electric dream governments are selling and the hybrid reality consumers are buying. First, let's look at a potential strategic pivot for Honda. The company isn't abandoning electrification, but it is dramatically reprioritizing. The writing is on the wall. Honda is going all in on hybrids. While the EV revolution grabs headlines, the quiet workhorse of the transition is the hybrid vehicle, and Honda is mastering this space. This isn't just speculation, the numbers are striking. In recent years, a remarkable portion of Honda's sales in Canada have been hybrid electric models. In some cases, hybrid variants of popular models like the CR-V and Civic have seen incredibly strong demand, sometimes even outselling their gas-only counterparts. From a business perspective, a decision to pause a massive EV investment becomes brutally logical. Why sink billions into a new, dedicated EV plant with uncertain demand when your existing factories can't build hybrids fast enough to meet current demand? The shifting customer demand is a direct reference to this. Consumers, particularly in a country like Canada, are expressing a clear preference. They want better fuel economy and lower emissions, but without the range anxiety, charging hassles, and high price that still plague many pure EVs. A hybrid offers a perfect practical compromise. This leads to the second point, the cooling of the North American EV market. The gold rush of the early 2020s has given way to a more sober reality. After years of explosive growth, the rate of EV adoption is slowing. While the market is still growing, it's not at the breakneck pace many had predicted. Automakers are responding to this new reality. Companies are throttling back production and reshuffling their EV plans. High interest rates are making expensive EVs less affordable, and concerns about charging infrastructure and cold weather battery performance remain major barriers for buyers in Canada. So, when a company says it's pausing based on evolving business conditions, it's looking at this data and making a calculated choice. It would be choosing to serve the market that exists today, a market screaming for hybrids, rather than building for a purely electric market that may not fully materialize for another 5 or 10 years. The suspension of a plant like the one in Alliston wouldn't be a failure of vision. It would be an act of corporate realism. A hypothetical suspension of Honda's project would do more than just expose cracks in the EV market. It would shine a blinding spotlight on the central pillar of Canada's industrial strategy: massive, multi-billion-dollar corporate subsidies. For years, the federal and provincial governments have been in a high-stakes checkbook competition, mainly with the United States, to lure these projects. The Honda deal, with its reported $5 billion in public support, is a prime example, but it's far from the only one. To grasp the scale of this gamble, we have to look at the colossal sums committed to Honda's competitors, Volkswagen and Stellantis. The numbers are almost hard to comprehend. For the Volkswagen battery plant in St. Thomas, Ontario, Canada has committed up to $13.2 billion in production subsidies. For the Stellantis LG plant in Windsor, the commitment is up to $15 billion. Together, those two deals alone represent a potential taxpayer outlay of over $28 billion. Let's be clear about what these production subsidies are. They aren't just one-time grants for construction. The money is a direct response to the American Inflation Reduction Act, IRA. To keep these companies from building in the U.S., Canada essentially agreed to match the production credits offered there. The federal government covers 2/3 of the cost, and Ontario covers 1/3. The governments have defended these staggering figures by promising a massive return on investment. The federal government suggested deals like the VW one would deliver huge economic benefits over the long run. However, Canada's own Independent Parliamentary Budget Officer, PBO, has painted a much more sobering picture. In a series of reports, the PBO found that the total cost of government support for EV manufacturing could be even higher than announced. For projects announced between 2020 and 2024, representing $46.1 billion in corporate investment, the total government support is estimated to be up to $52.5 billion. That's right, the taxpayer commitment is projected to be billions more than the companies themselves are investing. The PBO also challenged the government's optimistic payback timelines, estimating it could take 20 years for tax revenues to equal the cost of the subsidies for VW and Stellantis combined. 20 years. That fundamentally changes the calculus of these deals. The fragility of this subsidy-led strategy was laid bare during the Stellantis standoff in 2023. After initially agreeing to build their plant, Stellantis halted construction and demanded that Canada match the lucrative production subsidies VW had just been promised. The governments, trapped, had no choice but to agree to the massive new package. This incident proves that these deals are not locked in stone. They depend on external factors, especially policy from Washington, D.C. A hypothetical Honda suspension would be the first major crack in this subsidy-dependent facade. While the government could say the promised funds were never spent, the strategic damage would be immense. It forces us to ask if this is a sustainable model for economic development, or if we're just renting an industry with taxpayer money. If a cooling EV market and shaky subsidies are the internal pressures, the looming threat of American protectionism is the external hammer blow. A decision like Honda's couldn't be fully understood without looking south. A company statement might refer to a change in external resource strategy, a veiled but clear reference to the uncertainty in North American trade. For decades, the Canadian auto sector has thrived as a deeply integrated part of a continental system. The United States-Mexico-Canada Agreement, USMCA, known as CUSMA in Canada, is supposed to preserve this, but it contains risks that are now coming to the forefront. The core issue lies in the strict rules of origin for cars to qualify for tariff-free trade. The real danger, however, isn't the agreement itself, but how it can be used in a protectionist political climate. Analysts have warned about the possibility of a new U.S. administration imposing steep tariffs on auto parts or even all auto imports. Now, put yourself in the shoes of an executive planning a multi-billion-dollar long-term investment. A Canadian auto plant is built to export most of its production to the massive U.S. market. What happens to the business case for that plant if its products suddenly face a 25% tariff at the border? It collapses. The risk is existential. An industry association leader would surely say that free trade with the United States is and should be the first and foremost priority for the automotive industry in Canada. In the face of such profound uncertainty, the rational, prudent corporate decision is to wait, to pause, to indefinitely suspend. This risk is amplified by the upcoming mandatory review of the USMCA in July 2026. The agreement has a built-in review and sunset mechanism that requires all three countries to affirm its continuation. This review turns a stable trade pact into a recurring political negotiation. There are multiple potential outcomes, and several are deeply troubling for Canada. For the auto sector, which relies on predictable, seamless supply chains, this level of uncertainty is poison. A hypothetical Honda suspension would be a clear signal that the geopolitical risk of investing in Canada is rising. It would demonstrate that no amount of government subsidies can fully insulate a project from the threat of American protectionism. If a company as deeply rooted in Canada as Honda were to hit the pause button over trade uncertainty, what message would that send to other potential investors? It would tell them that Canada, despite its best efforts, may no longer be a safe harbor. To label a hypothetical suspension of Honda's $15 billion EV complex as merely disappointing would be to fundamentally misunderstand its gravity. It's not just a setback, it's a reckoning. Such a decision would be a critical turning point, a moment where the ambitious narrative of Canada's green industrial revolution collides with a wall of harsh economic, market, and geopolitical realities. Let's summarize the powerful forces that could converge to put a project like this on ice. First, the undeniable reality of the market. While governments push for a purely electric future, consumers have been voting with their wallets for a more practical, transitional solution: the hybrid. A company like Honda isn't abandoning electrification. It's following the overwhelming demand for a different kind of electrified vehicle. This reveals a clear disconnect between policy goals and consumer behavior. Second, we are forced to confront the staggering and perhaps unsustainable nature of our subsidy-based industrial policy. In a bid to compete with the U.S., Canada has committed tens of billions in production subsidies. But a major company pulling out would prove that even these colossal sums aren't a guarantee against market weakness or geopolitical risk. The Parliamentary Budget Officer has warned that the payback on these investments is measured in decades, and that taxpayers are footing a bill larger than the capital investments themselves. Finally, and perhaps most soberingly, there's the shadow of American protectionism. The stability of the North American trading relationship can no longer be taken for granted. The upcoming USMCA review and the constant threat of new tariffs create a climate of profound uncertainty. A pause from a major automaker would be a rational corporate response to an unpredictable political environment. When you weave these three threads together, a market pivoting to hybrids, a subsidy strategy that's both eye-wateringly expensive and fragile, and a trade environment fraught with risk, a decision to suspend a major project seems less like a surprise and more like an inevitability. This presents a critical test for Canadian leadership. It demands more than expressions of disappointment. It demands a fundamental reassessment of our entire approach. Are we prepared to continue this high-stakes subsidy game? Are we willing to re-examine aggressive EV mandates in light of clear consumer preferences for transitional technologies? And most importantly, what is our plan to insulate the Canadian economy from the shocks of American trade policy? The empty space where a multi-billion-dollar complex was supposed to rise would become a symbol of a promise unfulfilled, a strategy in question, and a future that is suddenly much more uncertain. It forces us to ask the most critical question of all. Is Canada's big bet on EVs, staked with tens of billions of public dollars, on the verge of failing? What do you think? Is a scenario like this just a temporary setback, or a sign of a much deeper problem with Canada's economic strategy? Let us know your thoughts in the comments below. This is a conversation every Canadian needs to be a part of. And if you found this analysis valuable, please like and subscribe. Your support allows us to continue looking into the critical issues shaping our country. Thank you for watching.